Hi there. Welcome to Commodities. I'm Lindsay Biscaya. Here's some of the stories we're tracking for you in the BNN Bloomberg newsroom. CTV News is reporting the federal government and the government of Alberta have worked at a deal on industrial carbon pricing. According to the report, Ottawa and Alberta are working around the idea of setting the $130 a ton price by 2040 instead of 2030. The announcement could come as soon as Friday and would be the final hurdle in their memorandum of understanding to get a pipeline to the West Coast built. And we are tracking shares of Algoma Steel today after it posted a first quarter loss of close to $160 million. That's along with a drop in revenue compared to the year before. The Ontario-based steelmaker says it incurred more than $27 million in direct tariff costs during the quarter. Algoma attributes these changes to its transition away from blast furnace operations to its new electric arc furnace platform. And Agnico Eagle Mines plans to invest about $14 billion in Ontario. The gold producer says the investment will span across existing operations, development projects, and exploration activities. The funds will also expand its Detour Lake Mine and Upper Beaver Gold Project. That move is one of the biggest private sector commitments in Ontario's mining industry as the province aims to boost local supply chains. All right, let's take a look at how some key commodities are trading today. We're going to start with energy prices. Oil down, actually, at the moment, down more than a full percentage point as the International Energy Agency is warning of shrinking inventories due to the ongoing conflict in the Middle East. You can see gasoline tracking that today, down by 2.3% at the moment. And if we're looking at natural gas, it is up ever so slightly, 0.3%. U.S. natural gas futures, these are rising amid lower production in the Appalachian region. Continuing to watch that for you, but we're also watching where some of the metals are trading at today. All three up right now. Gold ever so slightly. It was sliding earlier this morning. It's at 0.1% at the moment. Silver futures up more than 3%. So this is interesting. Silver is surging to its highest in nearly 2 months today, with TD Securities attributing this partially to renewed buying in China. Silver now on track for its longest win streak since December. We're also watching the price of copper. It is still approaching a new record high on the London Metal Exchange in particular, up now over a full percentage point. Metal prices are rising today, even as concerns about global inflation are reducing expectations for interest rate cuts. Our next guest is monitoring how diesel, sulfuric acid prices, and other supply challenges are affecting costs and production volumes amongst miners. So we want to welcome in Helen Amos now, Managing Director and Commodities Analyst at BMO Capital Markets. It's good to have you join us. Thanks so much.
Pleasure to be here.
So are you surprised at the moment that gold prices are not higher than what we're seeing over the last couple of weeks?
Not really. You know, we've had a few indicators that some of the physical sources of demand have been softening of late. You know, we've obviously had some central banks reporting sales. Some of the ETF flows have been a bit softer as well. So really gold at the moment lacks a catalyst to bring it out of this range trading environment, which is really holding gold in a narrow channel, and day-to-day moves are really being driven by, US dollar and treasury yields. And treasury yields are obviously coming under upward pressure again with the strong inflation data that we're getting out of the US.
I mean, I was going to ask, what was the reason for the recent gold sell-off that we've seen over the last couple of weeks? Are those the main factors then?
Yeah, I would say so. It's renewed concerns over inflation. I mean, we've had a few other headlines. It's difficult to disaggregate the exact drivers, but something that we think has been going on in the background as well is that India, a very important part of the demand side, has been pulling back from the market a little bit. And today it was announced, for example, that they are increasing the import duties on both gold and silver. And their Prime Minister, Modi, yesterday or the day before said that he was urging citizens to refrain from buying gold jewelry for the next year. And this is all because the current account deficit is under pressure. It's widening with high oil prices. That's putting pressure on their currency. So I don't think we can underestimate the importance of some of these changes beneath the surface that we're seeing, particularly in India.
Given those changes in India that you just mentioned, how much of an impact will that have on the price of gold and silver moving forward?
Well, I think it certainly doesn't help gold in terms of, breaking out of this range-bound behavior. But it's certainly, I think a trend that we need to keep on top of. Look, I think, at the moment, it seems like China is helping to buy the dips and also maybe sell when we rally, especially when gold seems to get a bit close to 4,800. And I think that's acting as quite a nice balancing factor in the gold market and maybe providing a little bit of downside protection as well.
We're also watching central bank decisions. Rate cuts no longer expected for the remainder of the year. In fact, we could potentially see some rate hikes instead. Should investors be cautious on gold right now and kind of wait until the conflict in Iran has resolved?
Yeah, I mean, reduced expectations of rate cuts is certainly, all else equal, a headwind for gold. However, I have to say what gold cares most about is actually inflation-adjusted treasury yields. So we tend to look at like 10-year tips yield. So obviously you've got inflation expectations coming into that. So that keeps that 10-year tips yield in a narrower range, which probably, again, caps the absolute downside for gold prices at the moment. And look, the World Gold Council did actually recently come out with their estimates for the total central bank buying for the first quarter. And actually that came in a lot higher than we'd expected. It showed 3% year-on-year growth. And that's because they have to account for the fact that we think there's underreporting in the system. So that was actually a little bit of an encouraging data point. But the thing that we're missing is just that. I think those retail speculative flows that we had really playing a big role over the last 18 months or so. ETF holdings, as I said, they're not back to where we saw pre-conflict. And then, as I said, some central banks have been selling as a result of the distress that they've been in, especially with their currency, as a result of the Iran conflict.
Interesting. Okay, as we were talking about off the top, we've seen increases in diesel, sulfuric acid, and other supplies. How are these increases maybe affecting mining input costs and volumes?
So it's very difficult to gauge at the moment. So one thing we've been doing is monitoring what all the companies themselves have been reporting. And I have to say they've been pretty cautious about changing any guidance ranges formally, but they have been giving sensitivities. And that seems to be coming out anywhere between about 3% and 15% based on the last reporting round. And that's based on a kind of like $100 a barrel oil environment being sustained. We've done some historical analysis, which suggests that, all else equal for a similar magnitude change in the oil price, it would be a bit higher actually, based on history, maybe like 9 to 20%. And that's, the direct effects of oil as an input. Diesel is a major input into the mining process, but also the indirect effects on consumables, electricity, labor costs. And I think it's still fairly early days. Obviously, some many people in the industry are hoping that the conflict comes to an end soon and that energy prices come down. And I think that's why some of the companies have been a bit less committed or committal about putting, absolute changes in their cost guidance yet.
I wanted to ask you about copper prices as well. We saw them reach all-time highs, almost all-time highs on the London Metal Exchange. In your view, is this driven by fundamental factors or just retail trading activity? Where's this coming from?
I think it's fundamental, actually. I think this is largely a physical tightness story. We've got, simultaneously the US and China bidding for units. The US, it's all about the tariff uncertainty again. So that stockpile in the US keeps rising. And China, the data that we're seeing on demand is incredibly strong, like they're front-loading investment, particularly in the grid. And this increasing demand, increasing bid on the demand side from China and the US is hitting up against basically, at best, flat mine supply. And if anything, falling. So, all else equal, that puts upward pressure on the prices. So, yeah, I mean, net positioning in futures is a lot on the long side, but not standout long. I don't think we've had a huge amount of retail. We don't tend to get as much retail participation in copper as we do in, say, the precious metals. So for me, it's very much a physical story. And we do actually think this has some legs, particularly between now and the end of June, when we expect an update on tariffs from the US.
Interesting. Okay, we'll have to wait for that. That's all the time we have, though, right now. Helen Amos, Managing Director and Commodities Analyst at BMO Capital Markets. Appreciate you joining us. Thanks for your time.
Thank you.
Up next, Franco-Nevada shares are rising today after the gold-focused royalty and streaming company reported record first quarter earnings. We'll have more on that after the break. Shares of Franco-Nevada are higher today. President and CEO Paul Brink said on the earnings call with shareholders that record first quarter results were driven by higher commodity prices and contributions from newly acquired assets, while benefiting from rising oil prices as well. So let's bring in Martin Pradier, materials analyst at Veritas Investment Research, for more. It's good to have you join us. Thanks so much.
Thank you.
How much of this quarter do you think was driven by higher gold prices versus underlying portfolio growth?
Well, yes, it was not only higher gold prices, because gold prices was up 70% year on year, but even better, silver was up 165%, and platinum was up 128%. So when you convert some of those silver streams or platinum streams into gold equivalent ounces, that, because they increase more than gold, then they convert into more gold equivalent ounces. So a lot was that. And then the new mines. I mean, they've been buying mines. So Porcupine and Côté Gold are some of the new ones, and some of the others that did okay, did well. But that's really the story. I mean, and I think it can get better because I think that the big catalyst that we're looking for is Cobre Panama. Will Cobre Panama restart? The government in Panama has allowed the power plants to start. It has allowed to export some of the iron ore that was there. So there are people being hired to process it. And the mine is going to, the actual mine is not starting, but the actual processing is starting. And it's expected that they finish the environmental audit now in Q2, and there will be a negotiation and we believe the mine will be restarted because Panama needs that mine, and that mine is big for them.
Okay, let's talk about that a little further then, Cobre Panama, because I was going to ask you about that. How meaningful would the resumption of that mine be? Like, how significant is that?
It's 20 to 30% of 20 to 30% of Franco-Nevada in terms of the ounces that they can bring. So it's very meaningful for Franco-Nevada. And for the country, it was 5% of the GDP or something like that. So for them, it's very important to restart the mine, and they need that in terms of jobs and in terms of the money that it helps the government to do all the things that the government needs to do.
Okay, going back to the earnings in this latest quarter, like I take your point that gold wasn't as much of an issue because you say silver was up, platinum, other projects that were happening. So does that mean if gold prices remain volatile, it won't really be impacting Franco-Nevada's next quarter as much?
No, I mean, it's just that year on year was up 70%. That's a lot. And year on year, again, is going to be up quite a bit, even if they are a little bit volatile. Because if you look back at the price at which gold was the same time last year, was much lower than today.
Okay. Franco-Nevada also said higher oil prices should help Q2 revenues as well. How significant is the company's exposure to oil today, as well as natural gas? Like, what's the connection there?
It's about 7% of the revenue in terms of oil. Natural gas is in North America, so it wouldn't change the price too much with what's going on in the Gulf.
And I want to talk about the CRA refund as well. Can you explain what exactly led to that CRA refund this quarter, and should investors view that as kind of a one-time benefit for the company?
It's a one-time benefit. It's related to basically they settled with the CRA in September last year, and the CRA had some money that was posted as security, and they gave that money and released a credit line. So it was about $50 million, the money that they received, and they released a credit line that was about $47 million.
Okay, so a one-time benefit for sure then. I take your point that this mine in Panama really meaningful for this company. Are there any other new portfolio additions or acquisitions that you think could really have a big long-term impact for Franco-Nevada?
Well, they're doing additions all the time, and they have a lot of firepower. They have $700 million in cash, and between some shares of companies that they have and the credit line, they can go up to $3.4 billion. So they're all the time doing additions. So I see that as, positive. As I said, in the quarter, Porcupine and Côté Gold did contribute quite a bit, and those two are very new mines for them. They just bought them.
Would you be a buyer of Franco-Nevada shares right now?
Yes, we have a buy recommendation, and we think it's going to do very well. And if Cobre Panama starts, we see the starting of the negotiation, I think the stock price will go up sort of very sharply at that point.
What if it doesn't restart as quickly as people are anticipating? Is that a major headwind for the company?
I think eventually will restart, but the valuations are very cheap. So you're not running a lot of risk because it's not into anybody's numbers. And the valuation for the company, it's, like one standard deviation lower than average. So very, very, very cheap.
Okay, we'll leave it there. Martin Pradier, materials analyst at Veritas Investment Research. Thanks so much. Appreciate your time.
Thank you.
Up next, steel producer Algoma is seeing its shares climb today despite reporting continued tariff headwinds in the latest quarter. More on what's driving the market optimism after the break. Algoma steel shares rose today, even as the company faces ongoing challenges from U.S. tariffs and a widening net loss. According to the CEO, Algoma is repositioning itself from a cross-border commodity producer to a Canadian-focused supplier. So let's welcome in Ian Gillies, now Managing Director at Stifel Canada, for more. Good afternoon. Thanks for joining us.
Thank you for having me.
How much of Algoma's weak quarter do you think was tied to the electric arc furnace transition versus broader kind of steel market conditions?
Well, one and the other are really tied together, but I would still suggest that a lot of the weakness is tied from the tariff environment. The company produced about 225,000 tons in the quarter. And if you think about where this facility could be producing, if the border was open, they could probably be something closer to 600,000 tons right now. And once you start losing scale, even with an electric arc furnace, you start to lose some profitability. So I would still primarily tie it to tariffs and less so to the EAF transition.
Interesting. Okay, so I do want to talk about tariffs in a moment, but I do want to stick with this transition, even though I take your point, it maybe wasn't the main driver here. Maybe can you explain the transition first to the blast furnace operations instead?
Sure. So for over 100 years, the company had produced using a basic oxygen furnace. It's an older technology. The margins are typically less certain, just given the number of inputs into it. And the company made a decision a number of years ago to switch to an electric arc furnace, which uses recycled scrap steel. The margins are a bit more stable. Typically, the valuations are a lot better for these businesses. The company had planned to go through a multi-year transition from the BOF to the EAF. They've significantly accelerated that timeline. They shut down the basic oxygen furnace in January because it was no longer economic. And so that's why you've seen them incur costs of, call it roughly $90 million in the quarter due to this accelerated transition to the electric arc furnace.
Do you think the shift away from the blast furnace operations is the right move long-term then for the company?
Wholeheartedly. When you look at the way an electric arc furnace can run, there's more flexibility in the operations. They tend to have more stable cash flow streams, which inherently drives a higher valuation multiple. And then on the altruistic side, it reduced emissions by 70%. And with carbon taxes rising in Canada when they made the decision, it was quite frankly a no-brainer.
Shipments dropped sharply in this latest quarter. I'm assuming part of that, at least, is from the tariff environment you were talking about off the top. Revenue also dropped sharply. How do you explain the increase in share price despite these results?
Oftentimes for stocks, things just have to go from being bad to less bad. I would suggest the liquidity position for Algoma exiting the quarter was a bit better than people would have expected. We're still expecting the business to get back to break-even EBITDA by Q4. And then along the periphery, even though this might not be seen in the Q1 numbers, there's a lot of positive changes happening. There's the defense spending program being put forth by the Carney government. That should be a material driver of steel demand, to which Algoma should benefit. The company's looking at a beam mill which would be another additive piece of the story. And then as we go through CUSMA negotiations this summer, it's obviously uncertain what will happen, but it's also hard to see steel tariffs getting a lot worse. And so if you have a bit of imagination for this business and you look out a number of years, you could easily see EBITDA getting back to $300 or $400 million just based on a variety of these initiatives.
Okay, so you mentioned the Canadian government offering some support to these companies and to this industry. Do you expect more support from the Canadian government, especially during this kind of transition period in Canada's industrial sector?
At this point, the company doesn't need any additional financial support. They exited the quarter with $550 million of liquidity. We think that will get them through at least the next federal election in the U.S. There might be derivative support by the way of contract awards from buying their steel, but they're going to sell that steel to someone. So if there is additional support, it won't look like it did through the financing package we saw towards the end of last year.
But at the same time, you also mentioned just how much the tariffs have been hitting this company hard. I wonder if you can explain in more detail. I know you were talking about it off the top, but just the amount of pressure companies like Algoma Steel are facing when it comes to the tariffs and the tariff situation.
Yeah, certainly. So, I mean, in the way I would think about that is that if you look at this time last year, roughly 55% of the company's sales came through the United States. They've repositioned the business. So now it's only 28% of sales. Tariff costs last year were hundreds of millions of dollars. This quarter, they were down to $27.5 million. So it's clearly been very punitive to the point where they've had to cut the production in half at the facility.
Wow. Given its current focus on expanding market share in this area, how do you think the company is positioning itself at this time within Canada's supply chain?
So they are the Canadian champion for Canadian steel production. If you look at the industry here, they're the only Canadian domiciled steel mill. The other two major steel mills are owned by an American company and a European company. So as a result, we anticipate that Algoma will be the Canadian champion for Canadian projects. We're already seeing some early signs of that. As you think about the Canadian sub awards that may come later this year, early next year, Algoma has already been awarded a $250 million grant from Hanwha, $200 million of which will be to build the beam mill, another $50 million in product orders. The company recently announced another JV with a private company outside Toronto to build armored vehicles. So the early signs are clearly there that they are going to be the defense champion.
Okay, we've got to leave it there. We're out of time. Ian Gillies, Managing Director at Stifel Canada. Appreciate your time. Thanks so much.
Thank you.
And thank you for watching Commodities. You can always email your story ideas to commodities@bnnbloomberg.ca.